Let's talk about Janashakthi Insurance. They've posted a profit number that honestly looks a little too good to be true. So we're going to peel back the layers and see what's really going on.
All right, a quick but important note. This is fundamental analysis for educational purposes only. It is not financial advice.
So, Janashakthi reported a staggering 249% jump in net profit. I mean, wow. A number that big just begs the question, where did all that profit actually come from?
And here it is. The answer is pretty clear when you break it down. A massive 55% of that profit, it came from market gains. Another 36% came from an associate company. And the actual core insurance business, the part that's supposed to be making the money, that was less than 10% of the pie. Wild.
And that right there brings us to what we're calling the profit illusion. It's time to look past that flashy headline number.
Now, to be fair, the company did grow its premium income by a solid 25.5%. That's some pretty strong top-line growth, you can't deny it. But, and this is a big but, look at the costs. Underwriting expenses just exploded, up almost 60%, and operating expenses climbed 19%. So here's the bottom line. Costs grew way faster than income in the core business. This was definitely not the engine of that profit growth.
So that leads to a really important question, right? If the company's profit is so dependent on the market, how exposed is its entire foundation to that kind of volatility?
To answer that, we have to dig into the balance sheet. We're calling this section Fortress with a Weak Point. Okay, and let's be really clear here. The foundation does look very strong in many ways. You're looking at a low leverage ratio, a really solid equity base, and they're actively paying down debt. On the surface, this looks like a very conservative, very stable capital structure. But here's that weak point. Take a look at their investment portfolio. Over 2/3 of it, 68.5% to be exact, is in what are called fair value through profit or loss assets. In plain English, these are mark-to-market investments. What that means is their value and the profit they seem to generate on paper can disappear just as fast as it appears. It all depends on which way the market swings. So, if the accounting profit we're seeing is that flimsy, how do we find out what's really happening? What's the ground truth? For that, you always follow the real money. And that's always in the cash flow story. And this slide just lays it all out perfectly. On one side, you have that headline profit growth of 249%. Huge, right? But on the other side, operating cash flow growth was flat, 0. The actual cash the business generated didn't grow at all. That is the ultimate reality check. So what did they actually do with the cash they did generate? Well, they paid down over $1 billion in debt, they distributed another $1 billion or so to shareholders, and they took in about $677 million in dividends from their associate. See the pattern? The cash was used for financial maneuvering, not for reinvesting in the core business.
Okay, so let's put this all together. Here's the final takeaway. 3 critical lessons for any investor looking at a company like this.
Lesson number 1 is something every analyst does. You have to normalize the earnings. What that means is you strip out all the volatile one-off stuff, like those huge market gains. What you're left with is the real, repeatable profit you can actually count on from the core business year after year.
And just look at the difference that makes. The company reported earnings per share of $12.33, but once you normalize it, once you take out the market noise, the real sustainable earnings are estimated to be way down, closer to $4.50. I mean, that is a massive, massive difference in how you perceive the value of this company.
And the last 2 lessons are just as crucial. First, you have to watch that asset allocation. When almost 70% of your investments are in volatile assets, your profits are living on a knife's edge. They could easily reverse if the market turns. And second, and maybe most importantly, always remember this. Cash is king. When accounting profit is soaring, but the actual operating cash is flat, you trust the cash. Every single time.
Which really brings us to this final thought from the source analysis. The reported profit is smoke and mirrors, driven by market gains, not core insurance strength. So what we have is a company with a rock-solid balance sheet for sure, but the growth story, well, that's an illusion created by the market, not by the business itself.